And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. We saw a record $986 billion in stock change hands on Friday. This is the largest dollar value ever traded on U.S. equity markets. That's according to Goldman Sachs. Think about that. Largest ever. There was also massive volatility around ETFs. How did they hold up? Let's talk to Chris Hempstead from IndexIQ, Nick Colas from DataTrek, along with Dan Wiener. He's chairman of Advisor Investments, and he's also the publisher of the Independent Advisor for Vanguard Investors. Chris, we've always heard the ETF haters say, wait till we get a lot of volatility. A lot of these ETFs are going to blow up because everyone's going to head for the door at once, and they're not going to be able to handle it. Well, we got historic volatility last week. You watch the ETF trading as a professional. What happened?
Look, I mean, the volume on Thursday and Friday in particular was extraordinary. There's nothing we've ever seen. The first hour of trading in ETFs saw what would be normally a full day's volume. Market makers, liquidity providers, the exchanges, CBOE, NASDAQ, and NYSE Arca have mechanisms in place to allow for fair and orderly markets. The old traditional verbiage we use on the floor. The markets held up remarkably well. ETFs did not see large premiums and discounts relative to the action we were seeing in the market. And the accessibility of liquidity from 9:30 to 4 o'clock, and even beyond that, was unlike anything we've ever seen. Remember, mutual funds, you're getting one source of pricing at the end of the day. ETFs afford you the ability to get in and out all throughout the trading day, and we saw a massive amount of gravitation to using ETFs.
So we always get complaints that liquidity isn't as strong. There was liquidity here. You might complain the prices went down really fast, but there was liquidity. Is that your point?
That's exactly right. I mean, the liquidity was in line with where the underlying assets were priced. You know, we talked about high yield. Yeah, there was pressure on high yield bonds, but there were people moving out of that asset class, not just using ETFs to do it, but they used ETFs all day as opposed to at once at the end of the day in a mutual fund.
And Nick, you and I were talking about high yield funds. The largest high yield ETF, HYG, lost 20% of its assets, outflows 20% of its assets last week. High yield spreads blew out. And what happened with these high yield ETFs?
No, you're right. The high yield outflows were 100% of all fixed income outflows last week when you add in JNK as well as HYG. And yet high yield spreads did not make a new one-year high. The one-year high was 470 over treasuries. We got to 460 on Friday, but not much worse. It shows you that the market held together.
Yeah. Dan, I want to turn to you. You run an investment newsletter for Vanguard Investors. They have a lot of good active managers over there. What have they been saying in the last few days? How is the active community?
The active managers find opportunity in these kind of markets. You know, I love Chris, and I love when he talks about traders getting in and out in the market on a day when the volume's really high. That's not investing, that's trading, right? Investing is finding great active managers, which we do. Some of the managers are at Vanguard, some are outside, but you compare them. I look to see how they did just over that very short period last week, 5 days, right? 5 days doesn't tell you very much. Maybe they were about equal with their benchmarks. So then I said, let's look out 5 years, let's look out 10 years. These guys kill these indexes and they kill the ETFs. They are outperforming over 5 years, they're outperforming over 10 years. So whether you're talking about a growth ETF, whether you're talking about high dividend yield
You're
stocks,
talking specifically about Vanguard active management,
I'm talking about,
quite famous.
Right.
For doing good active management, even though they're still an index shop.
Well, you have to choose.
Got the best
you have to pick and choose. A lot of their managers are bulked together in funds where there are multiple managers. You end up with index-like portfolios, but they've got managers who put the indexes to shame.
I want to talk about you as an advisor. You have your advisement fund has $6 billion in assets under management. What were you doing on Thursday and Friday?
We were watching, we were talking to our clients, very few of whom called in, and we were getting hold of our managers and saying, listen, is anything changing here? Are you finding opportunities? Most of them were very busy. They were, busy looking to see, is there a way for us to upgrade our portfolio? Can we sell something that hasn't performed as well or has not gone down as much and buy something that went down more?
But I want to turn to your instincts here, because I talked on Friday about the fact that the conditions are so stupidly oversold here on any kind of traditional metric. And what were you doing any buying? We had ridiculously oversold, extreme oversold conditions on the RSI, the number of new lows on the NYSE, the VIX volatility, the put call ratio, all these little internal things we all watch to say, say buy, sell, was screaming buy, and yet everybody had a deer in the headlight look saying, well, maybe this is that black swan event like 2008 where none of this stuff works, actually, and we're all going to get killed if we go back into the market.
We trimmed our high yield exposure a week or two ago, 3 weeks ago. We were looking at the spreads and saying, you know, we're not getting paid for the risk we're taking.
You dropped the high yield, Vanguard high yield, which from your recommended portfolio.
In the recommended portfolio, yeah, because you're not getting paid for it, right? But on Friday, actually, I think I mentioned you, our company was putting our profit share into the 401k for all of our employees. I don't know if it actually took on Friday.
Oh, no.
It will be in.
Don't tell me 800 points up, you're going to get it at the close today?
We saw inflows.
We'll
you had VOO up there. VOO saw inflows, despite the fact SPY saw outflows.
The S&P 500.
Yep, and we saw, look, there's different kinds of products that are out there. Liquid alts in particular. We got M&A and QAI, saw inflows in both funds last week and performance. So there are definitely products out there that people were reaching for, to your point, when they thought, okay, is the market oversold? What do I do? And how do I position my portfolio?
But don't forget that somebody might sell one S&P 500 ETF and buy another.
Yeah.
They're playing the tax trade there too.
Well, let me go to the volatility ETFs, because remember, we all remember how the VXX, some of the other volatility ETFs blew up 2 years ago, and everybody said, aha, you see, we told you about this. So there's these still around, VXX, TVIX. They traded very heavily on last week. We had huge outflows, and given that several of these VIX products blew up because of that big headache, how did they fare this time around?
Look, they learn a lot from what happened in February 2018. The market participants, the producers of products, and the investors, to your point, learned a lot about what not to do. And what they learned was how not to chase a product. So not only did the futures and options market hold up remarkably well in this last week of volatility, the ETFs themselves and the structure, they were very well prepared for this kind of a market.
So why is this? Why didn't things blow up? I mean, we had things like the BKLN. BKLN is bank loans, right? And everybody said, oh, these are thinly traded. If people start heading for the door all at once, there's not enough liquidity in these bank loans. The thing is going to fall apart, and yet it didn't, along with other things that everybody said. What magic has suddenly happened?
It wasn't enough. So look, on paper, academically, you're right. There's not enough liquidity in the market to take 10 years of inflows out in one single day. But despite the fact we saw record outflows in some of the bank loan or senior loan ETFs, it wasn't enough to disrupt the underlying market, or better yet, it wasn't enough to disrupt the process for the portfolio manager. They were able to fund those redemptions and then take on that risk of unloading those assets in the portfolio, which will, to your point, take them longer than a few days. In some cases, it might take 30 days.
Let me go back to investment ideas. Did you have to tell your clients, give them advice? What were you telling them on Friday? You saw the same extreme internal conditions I did. Did you have the same hesitancy? You tend, this is a master of probabilities here. You talk about standard deviations all the time. Yeah. 49 we hit on Friday. Yep. Was that a 3 or 4 standard deviation move from a typical move in the VIX?
Exactly 4.
4.
Exactly 4.
That's like 0.9% probability.
1 in a million days.
1 in a million days. A million days.
5 standard deviations is 1 in 3.5 million days. That's 5. 4 is just over a million. You should never see them, but we do.
Right. That's like 50 years.
Yes.
Yeah, but we had it in 2008.
For many days.
Yeah.
Yeah.
So there's something wrong with somebody's got to read through the probabilities.
This is what everybody talks about with fat tails in the market. This defines fat tails. Returns and volatility are not normally distributed. They have fat tails. Outsized events happen more often. We're telling clients it's pretty straightforward. You look at 2 VIX levels. You look at 42, which we hit just slightly over at 49 on Friday morning and bounced. That's 3 standard deviations. We should always bounce from there.
Right. So
don't forget, on an average year, the average intra-year decline in the market is 14%. We're only down today, what, 12 and a half? Well, not today, but Friday.
It is rather remarkable. We did this all day on Friday, that the entire global market was taken down 12 to 14%. Hong Kong was 14% off the highs. Thailand, Nikkei, the stock 600, the S&P, they just took the multiple down. It's like the entire world was taken down, like 12 to 14%.
But to your point, high yield did not get taken down. Investment grade didn't get taken down. And if you ask why didn't things break in HYG in the bank loan market, because the underlying market is still very strong. Now, if you saw a time where that market fell apart and equities fell apart, you might have more risk. But we did have the benefit of that market not falling apart last week.
For whatever reason, I can't think of a more stressful time. I certainly don't remember, other than 2008, than what we saw. And I was greatly relieved. And I didn't look at just this. I looked at internal functioning on the NYSE. I didn't see any breakdown. We didn't hit the circuit breakers. We had some individual stock circuit breakers hit the limit up, limit down, some of them. But they, by and large, worked okay. So I guess what I'm saying is at least the equity markets can say it, in a time of like almost unimaginable stress, it seemed to have functioned very well, which is what I care about. People want to sell or buy, whatever they want to do, they should be able to execute it without problems. And it looked pretty good to me on Friday.
Your observations were right.
I want to just get one other point in here. This is a slight side note. I want to note that the SEC again rejected a Bitcoin ETF application. Sorry to drag everybody in on Bitcoin here. This time from Wilshire Phoenix. Is this the last straw for Bitcoin ETFs? How 2 years we've been doing Bitcoin ETFs getting thrown out by the SEC?
I doubt very heavily that it's going to be the last straw. I think everyone will continue to listen to the feedback and the notes from the SEC, what their comments are, and they will continue to address it. At some point, when market demand and investor demand, pushes the pendulum to a certain area, they'll probably take another look at it. And have different kinds of consideration. I don't think it's the last straw, but I don't predict any significant changes from the SEC's decision in the near future.
Any thoughts?
That's right. You'll see a central bank cryptocurrency before you'll see a Bitcoin ETF.
Yeah, that just makes sense to me. A tethered coin, tethered to a currency like the United States, as a way to have frictionless transactions. So I got $1,000 in tethered U.S. dollars. Yep. In my account, I can move it anywhere I want in the world. I can buy anything I want. It's like a credit card, essentially, although it's not credit. That makes imminent sense to me. Yep. A Bitcoin that's not tied to anything, that just moves around, is too risky for me to have in my account. I don't know. Doesn't tethered coins make more sense?
I think you're onto something. I think that maybe part of what they're waiting for is a little bit more structure and oversight into the operational complexity of cryptocurrency transactions. Remember, these are ledger kind of transactions, so this is not something that's as standard as a DTC settlement. I think when we start to see more risk diversification and more understanding about how these various products, not just Bitcoin, how they operate, I think that's probably what's needed at the commission level.
Dan, is this all a lot of hooey to you?
More important is blockchain technology, right? How businesses are using blockchain. I mean, Bitcoin or any of these other coins are just a manifestation of a technology. Whether we care about it, do you use Venmo? I mean, people use Venmo right now. They can move their money around. It's not that big a deal. Do we really need Bitcoin? I'm not a drug dealer. I'm not worried about moving money.
You're saying the world's got it already. We already have effective
We have
way to move money.
many ways to move money around. I don't know that we need to be able to hide ourselves.
When I was in college, I was looking for that envelope from my mom to come in the mail. Now my son, who's in college, is a freshman. It's a Zelle or a Venmo every single time. That's all it is.
No, you're right. Good point. Okay, guys, thanks very much. Pleasure here. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Chris and Nick and Dan for joining us today. Thank you for watching. As always, you can find all of our latest videos right here on our website, etfedge.cnbc.com. See you next Monday, same time, same place. Have a good one.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds. Expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.